And today we're going to finish up the market structure of price action and the liquidity part. So we ended up on the order blocks, on the classical support and resistance. We'll talk a bit on the trend and trend lines. So the market can either be ranging or trending. So it can either be in a bullish trend or a bearish trend, or it can be consolidating. So if it moves in a consolidation, we say that it is in a ranging market. Now, in an uptrend market, price will be making higher highs and higher lows. So this is a bull market and this is a bear market. So in a bull market, we would have higher lows that are maintained, but the higher highs are broken. And the opposite will be on a downtrend where the lower lows will be maintained. I mean, the lower lows will be broken, but the lower highs will be maintained. So that's a downtrend. So as the market moves in an uptrend or in a downtrend, it will be creating channels up. And we use the trend lines to mark this channel. So a trend line will be drawn when 2 points have been made by the market, and for an uptrend we call them the traps. For a downtrend we call them the peaks. So this is an uptrend. So in order for this trend line to be drawn, these 2 points have to be there. So the market has to swing for the first time, create another swing low, and then swing for the second time. So with these two, you can easily draw a trend line. And you wait for the third touch for the third touch. Reaction on that trend line would give you your entry to buy. So the candlestick patterns forming around this other touches. So this third touch, the fourth, and the fifth will give you an entry. Also, for a downtrend, the same. You wait for the third touch in order for you to take your sell. So we'll come to learn again on the market maker trend versus the retail trader trend, and we'll come to see how market makers work around the trend lines. And you need to have that mindset of a market maker to trade like a market maker. So we'll come to see more on how these trend lines work. So SMT, smart money tool divergence. So smart money actions usually get revealed through cracks in the market, and here we'll be talking about the correlated pair. So usually smart money leave fingerprints in charts as they switch the tide of the swing, like as they switch from a bullish trend to a bearish trend. So, and this can be these fingerprints can be found around this correlated pair. So for example, for Euro USD and GBP USD. So when they reach in an area where you see there's a possibility of a reversal, for example, a resistance area, you would see one pair making maybe a higher high like this, while creating that M or the double top, and another one making a lower high. So usually the one making the lower high would start moving first, and then this, which makes the higher high, would come next. So when this moves, you are now sure that Euro USD will move eventually. And I think before Euro USD and GBP USD have had this fall last week, on the weekly time frame, we had SMT on Euro USD and GBP USD. Euro USD had a lower low.
Okay.
Euro USD had a lower high, and GBP USD I think had a high high. The same for when the market shifts from a bearish trend coming back to a bullish trend, you would find smart money making a higher low and a lower low on the other pair.
Sorry?
So this is a higher low here on EURUSD. They are switching from a bearish trend going to a bullish trend. So EURUSD made a low high, and GBPUSD will be making a lower low. And usually EURUSD would move first. So this would trigger a movement on GBPUSD. So you'll be sure that pound USD will eventually move. So we have a few examples. This is the dollar index. This is the dollar index. It had a lower low, and USD CHF had a lower high. No, this is a higher low. So this happened, and USD CHF, as you can see, it had a greater move than the dollar index. And then you see the retracement on the dollar index is very big compared to USD CHF. So a pair which has which forms higher low, or which forms lower high like this, usually moves have a greater move.
Yes.
It moves first, has a greater move, and has a very small retracement. So even this, it would have a very small retracement going up.
The small retracement is the lower low, right?
This one.
And higher high.
This, yes, the one with lower, no, the one with higher low and lower high. So the same occurred on EURUSD. So at the same time, when the dollar index and USD CHF had this SMT, EURUSD had this. It had higher highs. So at the same time, EURUSD also moved. So the CRB index is used to monitor commodity prices such as gold and oil. So CRB index has an inverse relationship with the dollar index. So in order for you to see a move on the dollar index, like to see a reversal on the dollar index, we also monitor the CRB index. It's on barchart.com. So the CRB index tends to be a bit early to change direction and can warn you for possible long-term shift on the trend. So basically, CRB index and the USDX correlation can warn us on a possible shift in trend on the dollar index. So we have talked of the market makeup. I mean the chart patterns. We have talked of support and resistance, and we have talked of the trend lines. We've talked of SMT, and all that would lead us to the market structure. Now, the market starts a long-term move on an area of support and resistance. That is by forming equal highs or equal lows on the monthly or weekly time frame. It is that way. So sometimes the market forms an intermediate term high, a long-term high, or an intermediate term low, or a long-term low around these areas of support or around these areas of resistance. So that if at all they form these reversal patterns, it should alert you of a possible market structure change or of a possible trend change. So the first thing that we usually do when analyzing the charts is to identify areas with equal highs or equal lows in a higher time frame. So look and note for clean highs and clean lows, and then you'll identify the current market structure and trade along with it. So this is EURUSD monthly time frame. You can see we had a downtrend here, and before we had a shift of the trend, the market formed a support area. So we see double bottom here. So after forming the support, we had this uptrend. So usually when it moves from this area, our target should be the next area of resistance or the next area of support. So we had a resistance area around this level. And as it reached here, we see that the market structure changed into a downtrend for around 3 months. So we had a bearish market structure, and then it met the 800 EMA. So exponential moving averages with higher periods, in high time frame, they are used as moving support and resistance points. So when price bounces around these levels, around these EMAs, we should expect for price to reverse direction. That's why here we saw that it bounced around the 800 EMA, and then we had a reversal. So it did break this bearish market structure. So this BMS is a break of market structure. And then before it went up, it formed equal lows. And then we had this uptrend. Before it came down, it formed equal highs. We had this downtrend. Equal lows, we had an uptrend. So you have seen that as the market moves from, the market starts a long-term move, it first forms a support area or a resistance area. So we, from the book, we have a few flashcards. So this was the dollar index. Now remember, this was the time when the dollar started this downtrend, and we had a very good downtrend after that. This is euro pound. We had a very good downtrend after this. So we had a very strong area of resistance here. You can see this is the weekly time frame. So if we narrow it down to the weekly time frame, we can quickly see a possible trend change. So monthly time frame gives us a bias for position traders, and that is a long-term bias of where the market will be headed. So when the market structure is broken, the next target should be the next support or the next resistance point. So usually use quarter numbers in identify targets in our time frame. We'll come to learn on the quarter theory. So weekly market structure can give us a good market flow on the daily and hour 4 time frame. That is what we are trading. We are trading the market flow. We don't trade the market structure. We need to know the market structure and have our buyers based on high probability, based on higher time frame setups. So based on higher time frame market structure, we come down to lower time frame and have our buyers for us to take a trade. So we are trading basically the market flow. So weekly market structure is good for swing trading. And after knowing the market structure on the monthly and the weekly time frame, you come now to the daily time frame, and it gives you the market flow, which is short-term bias compared to what we have on the monthly and the weekly time frame. So we can have a bearish market structure, but we can have a bullish market flow within that bearish market structure. But you would notice that, for example, this is EURUSD. We had a bearish market structure based on monthly time frame. So you would note that on the daily time frame, you would have long-term downtrends. Like the downtrends would have quite a number of pips compared to the uptrends. So when we learn on the market maker cycle and the resets, we'll come to see that the daily time frame also has 3 levels of rise, 3 levels of drop, and how do we use them to the lower time frame, which is the hour 1 time frame. So you would notice that after the dealer formed this area of support here, we saw that there is level 1, level 2, level 3, and then we had this the peak, and then we had level 1, level 2, level 3. So you would see that the 3 levels going down have quite a number of pips compared to these 3 levels going up. And this was the time when the dealer was changing the trend. So this was the time when the market structure was changing from bearish going to bullish. That's why on the lower time frame, it was very choppy. So it was at this area where I formed this equal lows, where on the daily time frame, we had this choppy movement. So you can see these pins on the monthly time frame. So when they're reflected on the daily, it was this choppy movement going up, down. So after forming these equal lows, we had a bullish market structure. So we had this bearish market structure, and then the market changed to bullish. So on the bullish market structure, when we come to the lower time frame, we would see that we had a long-term bullish and a short-term bearish, a long-term bullish, a short-term bearish. And before he moves, before he changes his direction from bearish to bullish, he would form an area of support, and then we had that. So basically, we wish to trade this, we wish to trade this. So that's what we are trading. Even this downtrend along this bullish market structure, we are also selling within, because we are swing and day traders. So the market maker method would come to clarify more on how to take how to trade the market flow. So that's what we'll be learning on the market maker method. So I think that's all on the market structure. And if you look at it, after forming this support, our next area, would be our next area of resistance. And this order block was our first target, because we have learned that order blocks are also classical support and resistance. So this order block was our target. And then it had this retracement. If you draw a line here, we had this area of support. So it came and bounced on that area of support, and then we had this uptrend to this level here. So let's talk on liquidity a bit. So liquidity in investing, we can define it as the degree at which a market, we're talking of an asset here or a security, can be quickly bought or sold in the market without affecting the asset price. So how quickly can you turn your asset into cash is how liquid is your asset. So if it's very quick, then your asset is very liquid. So in the Forex market, you can you enter your buy, you enter your sell, and they immediately filled. That means there is a high liquidity. So Forex market is the most liquid market in the financial market sector. And the daily turnover is over 6.6 trillion a day. And that's according to the 2019 report from the BIS, the Bank for International Settlement. So they usually give us these reports every 3 years. So the last report was on 2019. So in the Forex market, we have the dealers, we have the market makers, and the main responsibility of the market makers to provide liquidity, to make the market, to ensure that there is buying and selling pressure at all times in the market. So we have internal range liquidity and external range liquidity. Here we're going to learn on how the market makers creates a liquidity pool, fetches liquidity, and then creates a swing. Because in order for the market makers to create a swing in the market, then they need to have liquidity. So we're talking on internal range liquidity, where we'll be talking of fair value gaps, voids of liquidity, and we have talked of the order blocks. And for external range liquidity, we have talked of equal highs, equal lows, and support and resistance. So we're going to talk of liquidity, pools of liquidity. So let's start with fair value. So in investing, we define fair value as an asset sale price agreed upon by a willing buyer and a willing seller, assuming both parties are knowledgeable and enter the transaction freely. So when you go maybe to a store or the market and you see a price tag on an asset that you want to buy, and then you buy it, and then we say that price that has been put there is a fair value price. Like you have agreed to it as a buyer, and the seller has agreed to it, so the transaction has been completed. So in the financial markets, we have these secondary markets, and the importance of the secondary markets is price discovery. As at any time you would see the price of a certain stock, the price of a certain commodity, the price of, the exchange rate of a certain currency pair. So using these financial markets, and there's this hypothesis called the market, I think the market hypothesis. They say that the financial markets are always efficient, as in the price that you see in the financial market, quoted in the financial market, at any screen around the world is brought about based on the supply and demand, based on how traders have been trading, based on how traders see the market going. So that price is not, that price of a certain share or that price of a certain commodity, that commodity, that share is not overpriced, is not underpriced. It is efficient. So depending on how these buyers and sellers enter their orders and move the market is where this price comes to. So the markets always give out fair value price. So we have this Forex market, and in the Forex market, we are not matching orders. We're not actually matching orders. Usually market makers will take our orders and find other personnel or other traders who enter the orders in the other side of the trend, and they would match them. So it's like that. So it would occur that at one point in time, there are only buyers or there are only sellers. Like you would see only one side of liquidity. Like you would see only buyers, you would see only sellers. But the orders will be filled because the market makers are there. So you would see that there are certain price levels where there are only buyers or there are only sellers, and you can simply see them using the candlesticks. So those are missed levels on trade. Like at one point, maybe buyers were there, but sellers were not there, or sellers were there, but buyers were not there. So the market would seek to fill in these gaps or these missed price levels on trade. So you would see the market repricing to these levels as a retracement. And then eventually the market would move. So if you see candles like this, these two green candles, these are wide, these are wide candles showing only buy-side liquidity. These are wide range showing only buy-side liquidity, like it's a long range of bulls. But if you see candles like this, how this downtrend goes, you would see that before this red candle has been formed, we had a retracement, and then we had a fall. And then here we only had a fall, and then on the next candle, we had buyers came in. So here we had sellers, and then buyers came in, and then the market moved. We had market makers repricing, and then we had a downtrend. So each level in this area was a fair value. The price levels were fair value prices compared to this area here. So if this occurs, usually market makers would reprice, so allowing sellers to come in, so that these levels now would be fair value prices. So we call this a fair value gap before this retracement. And then after this retracement, now these levels here have become fair value prices. So you would see, for example, here we had on EURUSD, we had a fair value gap here. So we only had buyers on this area, and then the market moved. So this retracement here simply means market makers' willingness to reprice to levels not efficient traded for fair value. So making these levels fair value prices. And then we had an uptrend. And then you would see that the market came in to fill in this fair value gap. immediately after they filled, we had this reversal. So the market makers came in to fetch internal liquidity, and then immediately they had a reversal. We had another good example. This was a void. So retracements in the markets simply means a willingness on the part of market makers to reprice to levels not efficient traded for fair value. And there are actually no specific rules on time to fill this gap. So for example, for this Euro USD example, see, it took around, this was December and January, and on February it came in to fill. So you can see around 2 months is for them to fill this gap. So there is actually no rule, like maybe on the time, maybe you should fill it immediately or otherwise. So for the voice of liquidity, if you see a fair value gap, which is in a wide range, like here, see a wide range of one-sided liquidity, then it's called a void. So it's here, and we had this candles going up. So this was a void here created, and then the market repriced, and then it came in all the way to bounce on the order block, and then we had an uptrend. And if you look at this downtrend, we had this as a void, we had a void here, we had a vacuum, and then we had this area of the sellers. So you see buyers came in, and then on this area here, we also had sellers coming in. So in order to fill this vacuum with buyers and sellers, so the market repriced, and then we had this to fill in this, and in these voids, and then immediately it reversed on that order block. We had this was a fair value gap here, and we're having a void here. We had a void here. So this fair value gap right now is already filled. So we are waiting for the market to come to this void. So I wait for the market to bounce on this EMA. That's my target. Price right now is around this level. It went all the way here and then came down to this level. So I'm waiting for it to bounce to this EMA, and then we should have an uptrend to come and fill in this void here. So we had a very good void here on Euro NZD, and usually when a void occurs like this, usually the market would fill it very slowly, like this. Like, it's very rare when you find a void filled with a void. Usually a void is filled like this. I could see price moving very slow with pretty much retracements, and then it would fill in this void and then reverse. Okay?
Yes.
So pools of liquidity. So a liquidity pool resides just above a previous high or below previous low. So when you find the market creating a range like this, then the market makers will create areas of where there is a pool of liquidity. So above this, there is a buy stop area. Below this, there's a sell stop area. So buy stops means willing buyers at higher prices. Sell stops means willing sellers at lower prices. So in order for smart money to open their sell orders, the market makers would move the market to this area where there is buy stops, and then simply because there are willing buyers at that area, that means when smart money open their sells, immediately they would find the other side of the trade, like they would find buyers there. So their orders will be filled immediately. So that's why you would find that if the market breaks a previous high or a previous low, immediately it would have a retracement, simply because orders are allowed to be opened. So you would find immediately having a retracement, and then here we find another liquidity pool area, and then you have reversal there. So usually when I look at peaks, when I trade the market maker method, when I look at peaks, I usually like when I see that there is an area of liquidity pool that has been created and it has been raided. Like here, we had this area above as a liquidity pool area, and price came in and raided this. So smart money did raid this buy stops, and then immediately you would see that the market moved down. And it did not retrace from here. It came all the way down here below these lows, grab liquidity, and then we had a reversal there. So when you come to talk of reversals in the market, and that will be on the market maker method, you would see that when price reverse direction, it simply means market makers have already run into a level of stops and a new move should unfold from there. So here we had market makers creating these equal lows, grabbing liquidity down here. So we had a liquidity pool area, and then we had this uptrend. So that's all on the liquidity pool. So any question from there?
No.
Okay, so I had a very, very busy schedule today.
Okay.
So I would have wanted for our session to be very, very, a longer session, but I have a very tight schedule.
Okay, don't worry.
So we'll meet
tomorrow
again.
Yes, you can tomorrow.
Are you free tomorrow?
Yes, tomorrow morning, if you want, you can.
Yes, morning is perfect.
Okay. What you send me the time, okay?
Okay. Let's discuss it on the Telegram.
I'm free tomorrow. Okay.
Thank you for listening. I'll send you the recording as soon as it's converted.
Okay, thank you.
Okay.